Here is what the Florida real estate story is not telling you. The statewide numbers look fine. Prices up, people moving in, the Sunbelt narrative holding together on paper. But city by city, something different is happening. Homeowners are walking away. Not because the market collapsed, because their insurance carrier sent a non-renewal letter, because the replacement policy costs 3 times as much, because a house that penciled out in 2021 no longer pencils out in 2026 once you add what insurance actually costs now. This is not a prediction. This is not a future risk. This is happening right now across Florida. Today, we are counting down 10 cities where the insurance crisis is so severe that owners are abandoning their homes. If you own Florida property, you need to watch this. If you are thinking about buying, you really need to watch this. Let us get into it. Cape Coral is the largest city by land area in Florida outside Jacksonville. Over 200,000 people, miles of canals, waterfront lots, the kind of suburban Florida dream that brought retirees and remote workers flooding in during the pandemic years. Prices jumped hard. The median home that sold for $280,000 in 2019 was pushing $450,000 by 2022. Investors bought. Families stretching their budgets bought. And then the insurance industry looked at Cape Coral's flood maps, its hurricane exposure, its canal front density, and started doing its own math. The average homeowner's insurance premium in Cape Coral has gone from roughly $4,000 a year in 2019 to over $11,000 in 2026, according to the Insurance Information Institute. That is a 275% increase in 7 years. On a $400,000 mortgage at 6.5%, the monthly principal and interest is already around $2,500. Add $11,000 a year in insurance and you are adding another $900 per month. Flood insurance, which is separate and required for most Cape Coral properties, adds another $2,000 to $4,000 annually. The total monthly housing cost for a median Cape Coral home is now pushing $4,500 on a city where the median household income is around $68,000 a year. That math does not work. Over 19% of homes listed for sale in Cape Coral have had their prices cut, according to Redfin. Sellers are not cutting because they want to. They are cutting because buyers are running the full numbers now. Cape Coral is not emptying out, but the insurance crisis has permanently repriced what the canal lifestyle actually costs. Port St. Lucie sits on Florida's Treasure Coast, about an hour north of West Palm Beach. Population over 230,000. The pitch was always the same. Florida weather, space, a house that costs a fraction of what it costs in Miami, and close enough to the coast to feel like a good decision. That pitch worked for a long time. Then the insurance carriers looked at Port St. Lucie's wind exposure and its claims history after a string of active hurricane seasons, and they started leaving. 3 major carriers have stopped writing new homeowner policies in Port St. Lucie's zip codes since 2023, according to the Florida Office of Insurance Regulation. When carriers exit a market, the homeowners left behind face a version of musical chairs where the remaining players charge more because they are absorbing more risk. Premiums in Port St. Lucie have risen an average of 41% in 2 years. The overvaluation rate sits at 14.2% according to Zillow, meaning homes are priced about 14% above what local income fundamentals can sustain. When you layer an insurance spike on top of an already overvalued market, you get exactly what Port St. Lucie is showing right now. 21% of all active listings have had price reductions. Days on market are stretching past 60 days on properties that would have gone under contract in a week 3 years ago. The sellers are still hoping the 2022 buyer shows up. That buyer is not coming back at these prices with these insurance bills attached. Lehigh Acres sits just east of Fort Myers, deep in Lee County, one of the hardest hit areas in Florida after Hurricane Ian made landfall in September 2022. The storm caused over $112 billion in damage, the costliest hurricane in Florida history. And in Lehigh Acres, the aftermath revealed something that had been quietly building for years. The insurance market was already breaking before Ian hit. Ian just accelerated everything. 7 Florida-based insurance companies went insolvent between 2022 and 2024, according to the Florida Department of Financial Services. 7 carriers gone. Policyholders were automatically transferred to Citizens Property Insurance, the state-backed insurer of last resort. As of early 2026, Citizens carries over 1.2 million policies, according to its own published data. That is not a safety net anymore. That is the primary insurer for a significant portion of the Florida market. And Citizens premiums are rising under a state-mandated glide path, specifically designed to push policyholders back to a private market that does not want them at any price homeowners can afford. In Lehigh Acres, the median home price sits at around $260,000. That sounds affordable until you add an insurance bill averaging $9,000 to $13,000 annually. For a buyer putting 10% down, the monthly insurance cost alone can exceed $1,000. That is before the mortgage. That is before property taxes. 23% of active listings have had price reductions. Some have been reduced twice. The buyers who would have stretched for this market in 2021 are running the full numbers now, and the full numbers do not work. 7 insurers gone, 1.2 million policies pushed onto a state backstop that was never designed to hold them, and a median home that costs more to insure each year than many Americans spend on a car. Lehigh Acres is not collapsing, but the insurance math here stopped working long before most owners realized it. The assumption most people make about Florida's insurance crisis is that it is a coastal problem. Stay inland, stay away from the beach, and you are safe from the worst of it. Kissimmee is the city that breaks that assumption completely. Kissimmee sits in Osceola County, about 30 minutes south of Orlando. Population over 80,000 in the city proper. It is not on the coast. It is not in a named flood zone for most of its residential neighborhoods. By every intuitive measure, Kissimmee should be insulated from what is happening elsewhere in Florida. It is not. Homeowners' insurance premiums in Kissimmee have risen an average of 63% since 2021, according to the Florida Office of Insurance Regulation. Not because of flood maps, because the statewide reinsurance market that backs every Florida insurer, coastal or inland, has repriced Florida risk as a category. When reinsurers, the companies that insure the insurance companies, decided that Florida as a whole represents outsized hurricane risk, every carrier in every Florida zip code felt it. Kissimmee homeowners are paying for the coast even though they do not live on it. The overvaluation problem compounds the insurance problem here. Kissimmee's median home price sits at around $310,000 according to Zillow, against a median household income of approximately $54,000. That is a price-to-income ratio of nearly 5.8. The general rule of thumb for a healthy housing market is 3 to 4. Kissimmee is running nearly double that. 22% of all active listings have had price reductions, according to Redfin. The investors who bought for short-term rental income near the Orlando tourism corridor are now selling into a market where the next buyer is running the same broken numbers. Kissimmee is not collapsing. But the premise that inland Florida is immune to the insurance crisis just took a serious hit. The reinsurance market does not care where your street is. It has repriced the entire state. Ocala is a city of about 67,000 people in Marion County, roughly in the geographic center of Florida. Horse country, known for its farms, its springs, its relative affordability. During the pandemic, Ocala attracted buyers priced out of Tampa, Orlando, and Jacksonville. Home prices rose sharply. The median jumped from around $160,000 in 2019 to over $260,000 by 2022, a 62% increase in 3 years. And unlike coastal markets, Ocala's insurance picture looked manageable during that run-up. It seemed like the kind of Florida market that offered the lifestyle without the exposure. Then, the condominium crisis arrived. The Champlain Towers South collapse in Surfside in 2021 changed Florida law. New structural inspection requirements for condominiums over 3 stories and older than 30 years became mandatory. The inspections revealed deferred maintenance problems across hundreds of Florida condo buildings that associations had been quietly ignoring. Insurers, looking at the inspection reports, started either refusing to write policies on affected buildings or pricing those policies at levels that made monthly condo ownership in Ocala look nothing like the purchase price suggested. Condo owners in Ocala are receiving special assessment notices for structural repairs running from $20,000 to over $60,000 per unit, according to Florida realtors. For retirees on fixed incomes who bought Ocala condos specifically because they were affordable, a $50,000 special assessment is not a line item. It is a crisis. The inventory of Ocala condos has risen 31% year over year. Days on market have stretched past 75 days on units that were selling in 2 weeks in 2022. Buyers are reading the HOA disclosure documents, seeing the pending assessments and the insurance costs baked into the monthly fees, and pulling out of contracts. Ocala is not crashing. But the affordable inland retirement story that drove this market for years has been repriced by inspection requirements and insurance costs that no one saw coming when they signed. If you are still here watching insurance bills dismantle Florida's housing market city by city, we are the same kind of people. Subscribe. This channel covers Florida every single day, and the numbers only get more interesting from here. Daytona Beach sits on Florida's northeast coast, Volusia County, population around 72,000. One of the most recognizable names in Florida, synonymous with affordable coastal access that made it attractive to buyers who could not afford prices further. South. The median home sits at around $240,000, cheap by Florida coastal standards. That affordability made Daytona Beach a consistent target for investors and buyers looking for value on the water. The problem is that coastal affordability in Florida in 2026 means something specific to insurance carriers. It means wind mitigation requirements, flood zone designations, and carriers still writing policies, charging rates that reflect what a bad hurricane season actually costs. Annual homeowners insurance premiums in Daytona Beach coastal zip codes are now averaging between $14,000 and $19,000 depending on the age of the home, according to the Florida Office of Insurance Regulation. For a buyer purchasing a $240,000 home with 20% down, the mortgage at 6.5% runs about $1,200 a month. The insurance alone adds between $1,100 and $1,500 per month on top of that. The total monthly payment before taxes and utilities is now between $2,300 and $2,700. On Volusia County's median household income of around $58,000, that payment consumes over 50% of gross monthly income. Lenders cap debt-to-income ratios at 43% for most conventional loans. The insurance cost alone is pushing buyers out of qualification before they factor in property taxes. 26% of all active listings in Daytona Beach have had price reductions according to Redfin. More than 1 in 4 sellers conceding that their original asking price assumed a buyer who could absorb these carrying costs. The cash flow that justified investor purchases here no longer exists once you run insurance, plus management fees, plus the softening of post-pandemic travel demand. They are selling. The buyers they hope to find are looking at the full monthly cost and choosing differently. The affordable coastal access story that drove this market for years has been fundamentally repriced. And in Daytona Beach, that repricing is showing up in every listing that just cut its price for the second time this quarter. The shock entry on this list is not a small coastal town or an overheated pandemic market. It is Jacksonville. the largest city in Florida by land area. Population over 1 million. The economic anchor of Northeast Florida, with a deepwater port, 4 military installations, a financial services sector, healthcare, and logistics. Jacksonville is supposed to be the kind of city that weathers corrections because the economic base is too diversified for one factor to dominate. That assumption is being tested right now. Jacksonville's insurance market has deteriorated faster than most residents expected. The same reinsurance repricing that hit Kissimmee hit Jacksonville. The same carrier exits that stripped options from Port St. Lucie stripped options from Jacksonville neighborhoods east of I-95, where older housing stock sits closer to the St. Johns River floodplain. In Duval County, the number of active insurance carriers writing new homeowner policies dropped from 22 in 2020 to 11 in 2026, according to the Florida Office of Insurance Regulation. When you cut the competitive field in half, premiums do not stay flat. Average annual premiums in Jacksonville have increased 68% since 2021. On a city where the median home price is approximately $312,000 and the median household income is around $62,000, that increase is not absorbed quietly. It shows up in the monthly payment math that buyers run before they make offers. The military presence that Jacksonville residents cite as a stabilizing force has its own insurance dimension rarely discussed. Service members using VA loans are discovering that VA loan approval does not insulate them from the insurance market. The loan is guaranteed. The insurance premium is not. A service member qualifying for a $300,000 VA purchase in Jacksonville in 2026 is looking at an insurance bill that has no relationship to what that same property cost to insure in 2020. Over 20% of active Jacksonville listings have had price reductions according to Zillow. Days on market have stretched to an average of 61 days, up from 23 days in 2022. Jacksonville has not lost its economic momentum, but it has lost the buyer confidence that defined it for half a decade, and the insurance bill is the primary reason why. Sarasota has spent years at the top of every best places to live in Florida list. The arts scene, the Gulf beaches, the relative sophistication compared to other coastal markets. It attracted affluent retirees, remote workers with equity from California and the Northeast, second home buyers who wanted Gulf access without the chaos of Naples. For years, that premium demand kept Sarasota insulated from corrections hitting cheaper markets. The logic was that premium buyers could absorb higher costs. Premium buyers have limits too. Sarasota County sits on the Gulf of Mexico. Hurricane Ian made landfall roughly 60 miles south in 2022. The storm track spared Sarasota from the worst of the surge, but the insurance market did not spare Sarasota from the aftermath. Carriers that had been underwriting Gulf Coast exposure for decades looked at Ian's damage totals, looked at their reinsurance costs for the following year, and began repricing or exiting. Annual homeowners insurance premiums for a median Sarasota home, valued at approximately $550,000 according to Redfin, now range from $18,000 to $31,000 annually, depending on the home's age, construction type, and distance from the water. On a $550,000 home with 20% down, the mortgage at 6.5% runs approximately $2,700 a month. Insurance at the median of roughly $20,000 annually adds another $1,667 per month. The total monthly payment before property taxes is now pushing $4,400. Sarasota County property taxes on a median home add another $600 to $750 monthly. The full carrying cost of a median Sarasota home in 2026 is approaching $65,000 a year. That is more than the median household income of most American cities, entirely spent on one house. The ultra-wealthy end of the Sarasota market, homes above $2 million, is still moving. Buyers at that level are not financing and are carrying insurance as a rounding error. But the broad middle of the market, $500,000 to $900,000, where retiring professionals and equity-rich relocators were competing 2 years ago, is showing real strain. 31% of active Sarasota listings have had price reductions according to Redfin. Nearly 1 in 3 sellers. The insurance market does not grade on a curve for desirability. It prices for risk, and Sarasota's Gulf Coast risk profile is expensive regardless of how beautiful the sunsets are. If you are still watching at number 3 as Florida's most desirable markets start showing up on this list, subscribe. The top 2 are the ones that will change how you think about this state entirely. Tampa is the number 2 entry, and it is the one that shocks people. Major League Sports, a booming downtown, financial services, healthcare, the University of South Florida. Tampa's economic story over the past decade has been one of the most compelling in the Sun Belt. The median home price hit approximately $400,000 at the peak in 2022. In 2026, it feels like a number the market cannot sustain. Tampa sits on a bay that the National Hurricane Center has identified as one of the most vulnerable major metropolitan areas in the country to a direct hurricane strike because of the bay's geometry and the density of low-lying development surrounding it. Insurance carriers are not ignoring that research. They are pricing it. Average annual homeowners insurance premiums in Tampa have reached $14,000 to $22,000, depending on location and home age, according to the Florida Office of Insurance Regulation. For a buyer purchasing a $400,000 home with 20% down, the mortgage runs approximately $2,200 a month. Insurance at the median adds $1,500 per month. The total monthly payment before property taxes is $3,700. On Hillsborough County's median household income of approximately $66,000, that payment consumes 67% of gross monthly income. That is not a mortgage. That is the entire paycheck. Realtor.com projected a negative 2.1% price decline for the Tampa Metro in 2026, the first projected annual decline for a market that spent years as one of the fastest appreciating in America. On a $400,000 home, that is $8,400 in lost value in a single year. For homeowners who bought at the peak with minimal down payments, that decline is not just a paper loss. It is equity that no longer exists as a cushion between what they owe and what the home is worth. 24% of active Tampa listings have had price reductions, according to Redfin. The condo market is struggling under the combined weight of structural inspection requirements, rising HOA fees, insurance costs that have made older Tampa buildings nearly uninsurable at rational prices, and a buyer pool that has stepped back entirely. Tampa is not going to stop being Tampa. But the math of owning property here in 2026 is a fundamentally different calculation than it was in 2021. And for anyone who bought at the peak expecting Tampa prices to only go up, that negative projection is not just a number on a screen. It is real money that is no longer in their pocket. Number 1 on this list is the entry that will surprise people, not because Miami is unknown, because Miami was supposed to be the exception, the international city, the luxury destination, the market that foreign buyers, hedge funds, and wealthy relocators from New York and California turned into one of the hottest real estate stories in the country between 2020 and 2023. Miami was supposed to transcend the problems hitting everywhere else. Because demand was global, supply was constrained, and the buyer pool had no ceiling. That story is changing right now. Miami-Dade recorded a negative 4.3% median home price decline in 2025, according to Redfin data, in a county where the median home price sits at approximately $620,000. Negative 4.3% is $26,600 in lost value in 1 year. Gone on paper. That is a down payment on a home in most American cities, evaporated from the balance sheet of owners who bought at or near the peak. And the force driving that decline is the same force that has appeared in every city on this list, scaled to match Miami's price points. Homeowners' insurance premiums in Miami-Dade now average between $24,000 and $42,000 annually for properties at the county median, according to the Florida Office of Insurance Regulation. The range is that wide because it depends on the age of the building, the floor, if it is a condo, the distance from the coast, and which carrier is still willing to write the policy at all. For many Miami properties, particularly condos, built before 2000, the answer to that last question is Citizens, the state-backed insurer of last resort, because the private market has effectively exited those buildings entirely. A 40-year-old Miami condo carrying a $600,000 price tag and a $42,000 annual insurance bill is not a $600,000 asset. It is a liability structured to look like an asset until the renewal notice arrives. The Surfside collapse and the subsequent Florida condo inspection laws have layered a specific additional cost onto Miami's condo market that does not exist in the same way for single-family homes. Remediation costs in Miami are running from $50,000 to over $120,000 per unit in the most severely affected buildings, according to Florida Realtors Association reporting. Owners who cannot afford the special assessment are selling. Owners who can afford it are questioning whether a building that just levied a $100,000 assessment is a sound long-term investment. The condo inventory in Miami-Dade has risen 43% year over year, according to Zillow. Days on market for condos now average 89 days, up from 26 days in 2022. That is 3 times as long to find a buyer. 3 times as long means 3 more months of insurance premiums, 3 more months of HOA fees on a building that may levy another assessment before the current one is paid off. The international buyer who is supposed to insulate Miami from domestic corrections still exists at the luxury tier. Cash buyers from Latin America, Europe, and the Middle East are still closing deals in new construction with modern wind mitigation and known manageable insurance figures. But the resale market, the broad middle of Miami-Dade, where working professionals and first-time buyers were supposed to participate, has lost that buyer pool almost entirely. A household earning Miami-Dade's median income of approximately $68,000 cannot qualify for a mortgage on a $600,000 home and cannot absorb a $30,000 annual insurance bill. The math is not close. It is not a matter of stretching. It simply does not work. 38% of active Miami-Dade listings have had price reductions, according to Redfin. More than 1 in 3 sellers acknowledging that the price they started with assumed a buyer who no longer exists at that number. Some of those sellers will eventually find their buyer. Many will not. Miami is not going to become affordable. It is not going to stop being Miami. But the idea that Miami real estate is a one-way ticket took a direct hit from an insurance market that does not care about the view from the 42nd floor. A negative 4.3% decline in the most celebrated market in Florida is not a footnote. It is a signal. The insurance crisis is not a coastal problem, or an inland problem, or a condo problem, or a single-family problem. It is a Florida problem. And it has reached the top of the market. Those are 10 Florida cities where the insurance crisis is so severe that owners are walking away from their homes. From Cape Coral to Kissimmee to Miami, the statewide headlines about population growth and rising prices are real. But behind those numbers, there are real cities, real insurance bills, and real people making the calculation that the home they bought is no longer the financial decision they thought they were making.